Hello, everyone. I'm John Momartz. Again, I'm here with Bob Key, our CFA. Today is January 10th, 2024. This is our first economic update of the year. And to premise this uh, presentation, we are really excited that markets have now become much more normalized than they have been in many years. And we'll get into a little bit of the details of the history and what's happened and what we're doing going forward. So with that, Bob, I'll let you take it from there.
Thanks, John. Yeah, great word to use, normal. It feels good to say the word normal. It was interesting. We're starting to put our thoughts together for 2024, and um, I think the tendency, certainly in the financial press, is to make it dramatic because you get to attract viewers and all that. And we're putting ours together, and we came up with, kind of like, okay, here's the punchline. Wait for it. Things are going to be normal in 2024, which we have not had a normal year since probably 2019, pre-COVID. Really, if you want to go back, 2008, 2009, since the great financial crisis, we went to a zero interest rate policy, things have not been normal. We've had an extremely overactive Federal Reserve. They went to zero interest rate policy, made money for nothing, as they say. And we've been really dealing with just very, very active monetary policy. But where we are right now, um, after all the pandemics, the wars, the active monetary policy, is that I think we're entering a period of normalcy. So what you see in front of us is our strategic allocation. Strategic allocations are known as, some people call them a 100-year portfolio or a neutral portfolio, or just it's your long-term portfolio. It's where when you go and you start to build your portfolio construction, in the portfolio construction process, you say, if everything in the world is just neutral, where would I allocate my assets? And the answer is, here's how I would allocate my assets if everything was at fair value. What's important is that when we built these strategic portfolios 6 years ago, one of the biggest differentiators between what we did and what most people do is we did not take long-term average returns on the fixed income side. That's how most people start. What we did is we took the current yields, because in a zero interest rate environment, it never made sense to us that we should expect bonds to return 6, 7% a year as they historically have. They're going to return much less. And fortunately, that has proven to be very valuable to our investors that we did that. So here's what we talked about, the risk and return metrics of the U.S. stock market. Now, we can go back 100 years and we kind of say, okay, well, here, again, I don't want to get too deep into the math here, but, we take these different numbers, we look at them, and, you can see, the arithmetic mean, 11.8%, the geometric mean, which is what you'd use in your portfolio construction process, is 10.42%. We've always heard stocks return around 10% a year. Yeah, that seems to make sense with about a 15% volatility. We have no reason to believe when we built our portfolios that the next 100 years are going to be any different than the prior 100 years. The Federal Reserve in particular was not in manipulating stocks. They're not buying and selling stocks in the open market. We expected stocks to behave long-term as they have historically returned. So we used the long-term average return of stocks when we built our portfolio. The same is not true with bonds. So here's the 10-year 10-year bond yields, right? And we can see that if you go back and you go back all the way, boy, to the 70s, right? I mean, yields at that time were up, 14, 15%. But generally, you can see that we've always had these positive bond yields. And then if you go and you look at right there, 2008 or so, all of a sudden we're at these 5% yields. And what happens? The Fed comes in with this new, what was a theory that they put into practice called quantitative easing, where they went out into the open market and they started buying bonds. Obviously, you increase demand for bonds, the price of a bond goes up, the yield goes down. So they push bond yields all the way down, as we can see, from 2008 until 2020. I mean, down below 1%. That's just, unheard of. So as we're building these portfolios, rather than take that long-term 7% return that we've seen on 10-year treasuries, we looked along this line and we said, you know, why don't we just take the current yield? This seems to make a lot more sense. If bond yields are yielding 2%, well, then we expect about a 2% return. A lot of time they're yielding 1.5%, et cetera. That's how we built these portfolios for two reasons. One, of the two components of a bond return, one is carry. If you're making 2% yields, then the carry is 2%. Now, the other way to look at it is the only way a bond makes additional money is for bond yields to go lower. Well, they can't go lower than 0%. So the upside was extremely limited and the downside was infinite as bond yields could go up much higher. We can see all of a sudden, 2022, we got some inflation, bond yields shot up to 5%. We were treated extremely well by having less interest rate risk in these portfolios. So again, we take a look at these long-term returns. You can see, 10-year bond yields, between 5, 10, 15, they bounce around, but you're kind of getting that 7% return up until we went with the zero interest rate policy. What has happened now with these higher yields, the Fed has stopped doing their quantitative easing program, and we're seeing yields finally shoot up to where they should be. What we're doing is returning ourselves to a normal interest rate environment where the Fed is not manipulating interest rates and pushing rates artificially low. If you take a look at 10-year yields, traditionally where they trade is about 2 to 3% above inflation. Our forecast is for inflation to continue to come down, probably be around 2% by the end of this year. That will put the bond yield somewhere between 4 and 5%, which is right where it is. So what we did is we wanted to change our strategic neutral allocation to reflect the fact that we're no longer in this environment where the Federal Reserve is manipulating the long end of the yield curve, pushing rates artificially low, and that interest rates are likely to hang out at 4 or 5%. And bonds are once again going to be able to offer the historical, not just returns that they've offered, but also the historical protection they've offered, because they're the only negatively inversely correlated asset to stocks. When things go bad, bonds tend to rally, and they can only do that if they're up above that zero rate to begin with. So how we did that is we had the GOVT ticker symbol is what we were using for our government bond interest rate risk component. What we did is we split that position and moved it out to the SPTL. So now 50% is in each of these in our strategic allocations. You can see that one has a 5-year duration, one has a 15-year duration. Duration is just a fancy word for interest rate risk. So basically the interest rate risk on the SPTL, the long-term treasury, is 3 times that of our neutral one. By splitting it, what we've done is we've gone from about 4 years of duration to about 6, which is more in line with what the long-term average duration should be. We're no longer systematically underweight duration risk. We are neutral duration. We're neutral duration or interest rate risk going forward. So a bit of a technical note here. I want to pass this back to John, but the answer is it doesn't sound that exciting, but we have returned to a normal strategic portfolio investment environment because the Fed is no longer manipulating interest rates and pushing that zero interest rate policy that they were for so long. John?
Yeah, Bob, and I'd just like to add one thing in practice. As interest rates become more normalized and interest rates do come down, the short end of the yield curve is going to come down. And we've had many clients that have had a lot of money in these short-term money market funds that are yielding 5% plus. That is going to slowly go away, and we're going to have to find other places to put that money. So we're getting to that more normalized market environment. We're not quite there yet, but it's happening fairly quickly. And I think that's going to largely happen throughout the rest of this year.
So that's an important point. If you look at the yield curve right now, even if you wanted to invest your money for 1 or 2 years, it's significantly lower than the actual cash rate right now because the yield curve is anticipating that the Fed will be cutting rates and as they do that, then it instantaneously changes the cash rate.
Well, with that, thank you, Bob. Thank you all for listening. As always, we look forward to seeing you throughout the year. And if you have any questions, feel free to reach out to myself. We can even get you in touch with Bob if you like. Otherwise, have a great day. Thank you.
Thank you, everyone.